welcome to Investor's Guide, a show that helps you find the best investment products in the market. You know, we're here to help you and to hold your hand through any sort of stock market and through any sort of problems that you might have with your money. All you have to do is grab a pen and paper and send us a question, and it'll be our pleasure to take your question on the show. On the show this week, we'll find out if you should pay your home loan at this point or keep investing in mutual funds. Which one makes more sense? In our product review, we look at the Reliance Mid and Small Cap Fund, and we'll help a lot of young investors on the show, young women investors. One who wants to buy a home for her parents and the other who wants to save for her sister's wedding. It's time for me to bring in Narendra, the CEO of Value Research. Narendra, thank you so much for coming in.
Thank you.
Before we get to the questions that we have to ask, I have a very quick question for you. There was one news piece that came out this week about the fact that AMFI, which is the Association of Mutual Funds, has asked all mutual funds to insist that the service tax be borne by the distributor or the mutual fund agent instead of passing it on to the consumer. Now, as a consumer, I might think this is a great idea because it means that I no longer have to pay service tax on my mutual fund, transactions. But is this really a good thing for the industry, and what sort of impact will it have on my investments as an investor?
I think it is on a principle basis. It is wrong. In terms of spirit, it is right that mutual fund expenses should not go up. It has to be borne by the investor, and that actually brings down your return. So my sense is that but it is very unusual and in fact unfair to all the mutual fund people, all the mutual fund distributors, not being paid for the service they are rendering, which is basically a levy from the government, and I don't think they should bear that. So they should be paid the service. They should be and they should not be bearing that service tax. Yes, mutual fund industry collectively, whether it be registrars, whether it be the fund managers, the asset management companies, as well as the distributors, they should work towards bringing down the expense ratio anyway, because Indian mutual funds, particularly the equity fund and more so the smaller ones, they are perhaps the most expensive, fund management delivered in this country, because and to my understanding, Indian equity funds are most expensive in the world.
All right, so there is a need then, a case to bring down the costs and the fund management fees on our mutual funds. But in the meantime, as things stand, it's very likely that mutual fund agents will have to bear the cost of that higher service tax starting this year. Let's move on to our portfolio question. Untitled Chatterjee has written in Narendra. He's 36 years old. He does seem to have a very clearly sought out financial plan. He tells us he's married. He and his wife together earn around 1 lakh rupees a month. They have a home loan, which he pays 45,000 rupees. 10,000 rupees is what he manages to save. Here are his investments. 5 lakh rupees in a fixed deposit. That could be an emergency fund. He has 1 crore term insurance. He has health insurance of 22 lakh rupees. That's impressive. 1,500 rupees going into NPS every month and 1.5 lakh rupees in the PPF. He also has a couple of mutual fund investments that we can get to. I don't know if he really needs to put 1.5 lakh rupees in the PPF account on an annual basis. And his larger question is, should he be investing in mutual funds at this point, or should he be using that money that he's putting in his SIPs to pay off his home loan, maybe increase his EMI and knock off the home loan faster? It's a question that a lot of our viewers will be asking at this point, Narendra. Given where the market is and what your outlook is for the longer term, does it make sense to pay a higher EMI or to invest in a mutual fund?
No, I have a very clear view on this. One is that interest rates are likely to come down, so his EMI will actually get reduced. Not only that, till you are sure that if you are investing for the long run and you are likely to generate more return with your investments, that you incur, the cost that you incur on your EMI, on your home loan. So you should carry on with your investment. You should not prepay your home loan simply because you will be incurring 10.5%, 11%, or even up to 12%. But on a 10-year basis with regular investing, if you are going to generate more return, which is very likely, and an investor like him who has figured it out, is following a method, and I'm sure that with the ups and downs and the discipline that he's demonstrating, he is very likely to generate much more return than that. So he should carry on with his SIP plans and not prepay his EMI, his home loan.
All right, so continue paying your home loan. Of course, we're going to be watching those home loan interest rates very closely on this show to tell you when you can hope to see lower interest rates and even have them go down even further. Well, let's take a look at his mutual fund investments, Narendra. He has 5 mutual funds. Now, these are the ones he's using for his own retirement. ICICI Prudential Dynamic, UTI Opportunities and IDFC Premier Equity. He's obviously someone who picks his funds based on advice he hears on this show. Apart from this, he has HDFC Balanced and L&T Prudence, which he's investing for his daughter's higher education, he tells us. Now, he wants to know if his mutual fund portfolio is on track for the next 24 or 25 years. And if you believe that, he should be increasing his allocation, he wants to know how much he should invest right now in mutual funds in order to have today's equivalent of 1 crore rupees when he retires in 24 years, Narendra.
That will require, I think all he should do is be very liberal with the, inflation forecast. And it's, all these things will be very sketchy. But assuming that 1 crore has to be discounted by 7%, so that will be a huge amount, and correspondingly he will have to work towards reconfiguring his investment. He should definitely his long-term investment in PPF should get diverted. The annual investment of 1.5 lakh rupee in PPF should also get diverted to mutual funds, because that's a growth investment. I don't see any sense in having a long-term investment made into a fixed income. And for an individual who has a reasonable comprehension and also who is demonstrating the discipline of benefiting from a market-linked investment.
So try and put aside as much as you can, and remember, as your salary grows, you should also increase your allocation to your mutual funds. You have picked good funds there. You seem to be on track. Narendra, we have a question from a woman investor for you. Lakshmi has written, and she's 29 years old. She wants to invest 70,000 rupees a year in an ELSS and another 10,000 rupees every month in mutual funds for the long term. Now, she tells us her goal, and this is so lovely, is to buy a home for her parents in the next 2 to 3 years. She needs to save about 10 lakh rupees for the down payment. So she's willing to invest aggressively. Her current investment strategy, will it help her save 10 lakh rupees in 2 years? What changes should she make, Narendra? Of course, she shouldn't go too aggressive with equity if she only has 2 or 3 years as a time horizon. She should actually be putting aside more money. What would you recommend she does at this point?
No, I would say that 2 to 3 years time is just not good enough for you to accumulate savings in a manner that you will be able to achieve the goal of putting the down payment. But that apart, I would say that for 2 to 3 years time frame at best, the very aggressive allocation will be choosing a balanced fund and investing regularly. And maybe with your tax saving fund, the 70,000 rupee, you can get aggressive with that. You get locked in for 3 years anyway, and that should be your long-term allocation for yourself. So 2 to 3 years time, I would very reluctantly suggesting balanced fund. 2 to 3 years is just not good enough time for anything which is dominantly equity.
But then she also wants to put aside 70,000 rupees every year to save tax, obviously, in an ELSS. For an investor like her, what sort of an ELSS should she be using?
No, she has actually expressed a desire to, grow her money aggressively. And in our selection of ELSS, we have funds which are relatively conservative and funds which are very aggressive. She should consider the aggressive tax savers and invest regularly, not invest this 70,000 rupee at one go. I think, Reliance tax saver or ICICI Prudential tax plan or Access long-term equity, they will qualify as one.
All right, so on your screen right now are the tax-saving funds that Narendra has recommended. You've also told us, Lakshmi, that you'd like to buy health insurance. A quick piece of advice for you would be to buy a separate policy for yourself and a separate policy for your parents, because if you all club under the same policy, automatically the price per person goes up based on the age of the oldest person. So buy a senior citizens policy for your parents, which is also tax deductible for you, and buy a separate health insurance policy for yourself. Ideally, if you live in one of India's big cities, you should have a cover of about 15 lakh rupees. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. It's time for our product review. And before we talk about the Reliance Mid and Small Cap Fund, Avan will give us a quick background into that fund. Avan.
Thanks, Faye. Under the scanner this week is the Reliance Mid and Small Cap Fund. This fund was called the Reliance Long-Term Equity Fund till January of this year. Now, the fund is co-managed by Sunil Singhania and Sameer Raj. The investment process displays a growth bias. Typically, the managers invest in growth stocks that they think are reasonably priced. They seek out companies with a scalable business that they believe can double profits in 3 to 4 years. The adherence to mid and small caps, even in testing markets, shows the conviction of the fund managers. The fund has given a return of 15% since its launch in 2006. In terms of performance, it has mostly remained in the middle of the pack. Although the fund has managed to beat its benchmark fairly consistently, it's only managed to match its category average and ranks 26 in the category over a 5-year period. So should this fund feature in your portfolio? Let's find out. With that, it's back to you, Faye.
All right, Aman, thank you for that information. Narendra, Reliance Mid and Small Cap Fund, that's a new name for an old fund. It's currently rated at about 3 stars on value research. It's sort of middle of the pack, really. And given the market we're seeing right now, where a lot of analysts are turning around and telling us that, the mid and small cap funds is where we're going to see the most pain over the next 6 months, do you think it's time for investors to move out of this fund, or at least be more careful when they choose a mid cap fund?
Yes, investors should take lesson from this correction, because what we have seen in the last 6 months, or even last 1 year, that investors are more curious, they're more excited, and investors chase performance, recent past performance. And they have been, these funds were on the forefront. Some of these funds went up by 100%, and investors were trying to capitalize on that or ride on that momentum. And to their surprise, things have turned around marginally. It has become a little shaky. So investors should have very clear understanding of what they are getting into. About this fund in particular, though it has slipped on the rating, but I consider this fund as an outstanding fund. Here is a fund company which made a name for itself by by choosing great mid and small cap stocks ahead of others. It has been ahead of curve, and this fund has also demonstrated that. If we see its initial years before the boom, this was on top of the pack. So this is a fund which will always do well in good times. Right now we find that the fund looks a little shaky in its category, simply because we have a large number of relatively smaller cap fund in this category, which makes it look little worse. But I would say that it's still a very impressive mid and small cap fund, worth considering despite its rating.
So what sort of an investor should consider a fund like this one, Narendra, and what sort of risk should the person be prepared for over the next couple of years?
No, one is that when you this kind of fund really requires a strong stomach. You should be fully aware that this is a fund which can go down in value in a brief period of time, and it will. So there are ways to mitigate this. One is to have this understanding, that itself helps. The other is be regular with your investing. Because if you catch a high or catch a market peak with this fund, you will be greatly disappointed. So be regular with your investment. Have the understanding that this fund can actually go down in value by 30–40% in a year's time, and you should be fine with that. Because on a 5-year, 7-year holding period, it will prove to be more rewarding. And about the stock selection the fund's ability to demonstrate superior performance, I think it has been reasonably proven. So investors who get very disappointed with a 20% decline in 3 months' time, I don't think a mid-cap fund or any mid-cap fund or a small-cap fund is for them anyway.
All right. So remember, this might be a good fund for you to pick up, provided you have the stomach for the kind of risk that it comes with. On the odd year, when the market is bad, you might cut 30–40%, which is what Narendra is saying. But if you're prepared for that over the long term of 6 to 7 years, it will certainly reward you. Narendra, finally, what's your rating for this fund on Investor's Guide?
If an investor is looking for an aggressive growth fund and understand it, fully appreciates the risks, then I would assign it a 4-star fund.
4 stars there for the Reliance Mid and Small Cap Fund on Investor's Guide. Let's move on to our hold or sell segment. Udhira Sharma has written in. He's 25 years old and he recently started investing in mutual funds, Narendra. He's currently putting aside 9,000 rupees in 5 different funds, and that's so impressive for someone his age. He wants to know what sort of returns can he expect from this portfolio in the next 10, 20, 30 years. So he's obviously an aggressive investor, and he sent us a list of the funds that he has. I'm going to call out that list one by one. Right on top is the Franklin India Prima Fund, Narendra. It's a good fund. Should he continue that investment?
Yeah, it is perhaps the oldest pre-stated mid-cap fund, and he should hold it. It's a very high-quality mid-cap fund. It might not be ever, on a brief period of time, ever on top of the pack, but on a 5-year, 10-year basis, it always shows up. So hold it.
Well, I want to know how this complements the other 2 funds on his list, and considering he just began investing, it's likely that he's possibly reacting also to recent performance. He has the Franklin India Smaller Companies Fund and the HDFC Mid-Cap Opportunities Fund. While granted these are both excellent funds, is he, should he also be prepared for the kind of risk he's taking on?
Yes, he should fully appreciate that, and if he has just got carried by the kind of returns these funds have provided in last 1 year, 1.5 years, that's a wrong starting point. Don't expect that to happen consistently, and beware of the big slips that will happen. But if he's doing his SIP and appreciates that, potentially this can prove to be hugely rewarding for a disciplined investor who can withstand all the volatility.
Well, the next on his list is the ICICI Prudential Tax Plan. He's putting 500 rupees a month in this plan. Is it the best tax saving option for him in the market? Would you like him to continue that investment?
Yes, it's a good tax saving fund. Of course, we have too many good tax saving funds, but this fund also will qualify as a good one.
Last on the list is the iProve Value Discovery. I know you're going to approve with this one, Narendra, because it's something that you recommend as well. Continue this investment?
Yes, this investment, as well as when I look at this investment portfolio holistically, this will be a portfolio which will prove to be extremely disappointing if we are faced with a very difficult market, and to benefit from this, and at the same time I'm very confident that the kind of fund he has chosen will prove to be very rewarding in a 5-year, 10-year time frame.
So stick to that fund. And to answer his basic question, Narendra, what sort of returns do you think he can expect in the next 10, 20 and 30 years? I know it's impossible to ask anybody to predict where the market is going to be over the next 3 decades. But if he continues to invest in this systematic manner, in a focused manner over the next 30 years, what can he expect?
Looking at his portfolio, I'm confident. It's very difficult to guess, what a portfolio will produce over the next 20, 25, 30 years. But I'm confident of, this portfolio beating inflation, beating fixed income return, and beating Sensex as well. Of course, I'm not saying that all these funds will continue to be great funds as they look today. So one will have to periodically review. But if you retain your orientation towards such funds and do a periodic review. By periodic review, I mean if you evaluate your fund selection every 2-3 years, that should be good enough. So I'm confident that you'll be able to beat inflation, fixed income return, or the risk-free return, as well as the Sensex going by your selection.
All right, Dheeraj, so what Narendra is saying is that basically if you stay disciplined and you invest on a regular basis in this portfolio that you've put together so admirably, that you will do very, very well over the long term. And of course, you will accumulate a fair amount of money. So in 30 years, you're going to be a rich man. Narendra, thank you so much for joining us on the show and answering all of our questions. We look forward, as always, to have you on the show. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. Gajendra Kothari is here to answer a couple of your questions that you sent in during the week. Gajendra, welcome to the show. Our first question comes in from Maria Danielle Deepak. She writes in saying she's saving for her sister's wedding. It's likely to happen in the next 8 years. Maria, you are a wonderful sister to have, and I'm sure your sister is very pleased to have you in her life. Now, Maria's been planning to save about 6.5 lakh rupees by the end of the 7th year. She's planning to put aside 10,000 rupees a month initially and add that to 2,000 rupees every year. She's looking for consistent growth and doesn't want to take very high risks. Please give her a couple of investment ideas. Gajendra, first of all, what should she be investing on a monthly basis to achieve that target, and what sort of an investment avenue would you like her to use?
Hi Maria. I think you've planned it very well. So if you're starting with 1,000 rupees and adding 2,000 rupees every year, by the end of 6th year, just imagining that you get 10% return on a balanced fund kind of a portfolio, wherein it's not very high risk, not very low return also, it's medium risk and medium return. At the end of 6th year, this 1,000 and 2,000 per annum would fetch you roughly around 10 lakh corpus for your for the marriage purpose, so which I think is very high compared to what you require. Now, if you want 6.5 lakhs exactly, then I would recommend you have to just put 1,200 rupees per annum. So right now this year you're putting with 1,000, but next year onwards you're putting 1,200 rupees per annum. I think that should be fine, and then you'll be able to achieve 6.5 lakhs rupees, assuming 10% return on your portfolio for the next 6 years. The kind of funds which you can go for, again I would suggest funds in the balanced funds category. You can pick any one of the fund like HDFC Balance Fund, Birla Sun Life Balance Fund, or ICICI Balance Fund. One of the three you can choose and pick, and you can remain invested.
Our next question comes in from Deepak Joshi. He's 27 years old. He wants to put aside 50 to 60,000 rupees for the next 4 years every year in an equity-linked savings scheme. He wants a few funds that we can recommend.
Hi Deepak. I think it's a brilliant idea for you to invest in ELSs since you are young. You can take some kind of risk. You have a long-term horizon. So this is a wonderful vehicle. ELSs, yes, you have the option to invest both annually as well as monthly, whichever is comfort to you. So you can put and expect around 12 to 14% return per annum over long term. If we see the last 10 years, 15 years track record, the ELSS funds has given somewhere around 15 to 18% return per annum, which is quite commendable. Which funds to invest in? Well, there are many which has consistent track records, but I'll just name few funds, and you can again choose one of them. You don't need to kind of pick 2 to 3 and invest. So you can either consider investing in either Axis long-term equity fund, or Franklin India tax saving fund, or Reliance tax saver fund. So any one of the 3 I think should be fine.
All right, so on your screen right now are the aggressive and the conservative equity-linked savings scheme or tax savers that we recommend on Investor's Guide. If you want a copy of this list, write to us and someone from our team will email a copy to you. So remember, all you have to do is get in touch. There's email, there's Facebook, there's Twitter on which you can reach me personally, and we'll be glad to help you out on this show. Until next week, thanks for watching.